Well, welcome everybody. And I just want to tell you, we're still waiting for more families to get on the Zoom meeting. So we're going to give it just a couple of more minutes and then we're going to go ahead and start. So I'll be right back. Hello again. We're still waiting for a few families that are in the middle of getting on for our client webinar. So we're going to give it about one more minute and then we're going to start. Okay, so I'll be right back. Well, we're going to go ahead and get started. We still have some people still getting on. My understanding is we are going to have about 150 families on here tonight, which is very exciting to have that kind of a turnout. But I'm Mike Pearshell. I'm the president of Pearshell Financial Group. I know most of you know that, but we also have some guests on here tonight. And what we're going to do over the next hour is I'm going to give you a little update on where our model is, our advance and protect model. And then we're going to talk a little bit about are we in a recession? If you believe the powers that be, for example, our Fed chairman or our president, they're still not willing to say we're in a recession. So we're going to talk about are we or are we not? And why is that so blasted important? And then we're going to talk about recessionary bear markets. And I'm going to show you a little history on those. We're going to talk about bonds and what in the world happened to bonds this year. And then, there are some of our clients that are in a model where under the right conditions, we actually take a small part of the portfolio and short the market. Short the market means you make money when stocks go down, and we're going to give you a little bit of a update on that. So this is going to be a real fun hour, at least for me, hopefully for you too. And so I want to start by giving you an update on the status of our buy sell signals. And this, folks, is as of today. And this is what it looks like right here. The short-term signal is negative. That's our short-term stock signal. Our medium-term signal is negative, and our short-term signal is negative. In other words, all three of our buy sell signals for our stocks are negative. Also, if you notice on the bottom, we don't talk as often about our bond signal, but we do have a signal for our bonds that can trigger. It's very rare, by the way, and but it went negative this year in January, thank goodness, because as we'll get into later, and by the way, excuse me, I have to get my water here, but as we're going to get into a little later on, folks, this is the worst year in history for bonds for the first 6 months of the year based on the 10-year Treasury. And I'll be coming back and talking about that in a few minutes. So in the history of our model, it's only been in about 20% of the total trading days where we have had all three of our signals turn negative at the same time. So it happens about 20% of the time. But the number of trading days where all three of our stock signals were negative, while at the same time the bond signal is negative, is much more rare. In the entire history of this model, we've only seen this about 5% of the total trading days that this model has been in existence. So that's very rare, what you're seeing right now. So what is this showing you, folks? It's showing you that we're completely out of the stock and bond market. Now, again, I'm getting a little ahead of myself, but I just kind of want you to know, and we'll be talking about where we're at and all of that here just a little bit, but just want you to know, at least according to our research, this is a very high risk environment that we're in right now. We believe that the next wave of the bear market could likely happen before the end of this third quarter. And we're in September already, folks. But I believe we're going to see the next wave of the bear market start at somewhere, if it hasn't started already, in the next few weeks, where we would see investors start capitulating, which is a fancy word for panic selling, to basically stop the losses. And what I believe will cause this is the worry as analysts are starting to lower their earnings estimates as the Fed continues aggressively hiking interest rates, because historically, when you hike rates high enough, it kills earnings. And when earnings start declining, that's the number one thing that'll make the stock market start going down. And folks, we would not be surprised to see if the stock market drops significantly again over the next couple of months. And if this occurs, we should be in a good position, because we are completely out of the market to take advantage of what could eventually be an incredible buying opportunity. Because if it keeps going down, all the people in the buy and hold models are going to go down with it, and we're not, because we're out of the market. Now, currently, we are 100% in treasury bills and government money market funds, which are basically cash equivalents, folks. And again, while being in cash is not the best long-term solution, on the other hand, assuming further declines, it offers the advantage of maintaining the value of your portfolio assets. while waiting for the markets to get to their cheapest prices. That's how it made money in the '01 drop, in the '02 drop I just showed you, in the '08 drop. That's how it did it, folks. And we'll be getting into that a little more in the next few minutes. But also, I want to say that even though we are confident that we are in a recession and that this bear market is not over, keep in mind we are assessing things daily with the help of our 3 buy-sell signals as well as our bond signal. And if the economics landscape changes, which is not likely, we will be prepared to respond accordingly. Because, in other words, what I'm simply saying, if the market bottom is in and the stocks really start going up, guess what? Our signals will all turn green and we'll go back into stock. And we might start out a little behind, but guess what? For most of you, when all 3 signals turn green, we drop the bonds and go all stock. And because we have more in stock, we start rising faster. We catch the buy and hold models and pass them. And that's what has happened historically, especially in these type of declines. But on the other hand, if this does get worse, as I just said, we're going to be in a great position to take advantage of what could be a very good buying opportunity. So I just wanted to paint a little background, folks. Now I want to show you something else. Now you notice my slide says BlackRock, the 800-pound gorilla, has spoken. Well, BlackRock is the largest money manager in the United States. They have over $1 trillion. Can you imagine? Under management. BlackRock has, for example, BlackRock mutual funds. They also have the iShares, which is a very popular ETF. And I want to tell you, as big as they are, they're still a typical buy and hold type of financial institution where they make their money if you stay in their mutual funds, for example. So it has to get pretty bad for the analysts at BlackRock to start warning people to reduce their stock. Well, in the recent weekly commentary of BlackRock, and I've actually got it, I don't want to, people always tell me I'd be terrible on TV because of the way I do this, but they recently said, this is in the last 2 weeks, that they do not think the current stock rally is sustainable. And why? They see the Fed hiking interest rates to a level that will stall any kind of economic restart as corporate earnings weaken. And the other thing they said, and I'm just reading this, the risk of disappointing earnings is one reason we're tactically underweighting stocks. That's their polite way of saying you better reduce your stock levels. And this is the largest money manager in the United States that is, again, a buy and hold type of company. Now, here's something else, folks. Do you know, a few days ago, Fed Chairman Powell, now he made some more comments today, I know, but actually, a few days ago, Powell declared that there would likely be some, quote, pain felt in the economy as the Fed raised rates to bring down inflation. And that was one of the phrases, pain, that caused the steep sell-off. I'm sure when Powell goes home at night, he walks in his house, he shakes his head and can't believe the influence his words have. And then his wife says, honey, take out the garbage, will you? But nonetheless, in making this warning of pain, Powell became the 3rd Fed chairman in my career to explicitly warn of tougher times ahead for the economy. And folks, it's important to realize Fed chairman explicitly warning of future pain is not normal. They are almost always cautiously optimistic, very careful what they say, or non-committal on the path of growth. Okay, very seldom will a Fed chair make this type of warning, and this was just the 3rd time we've heard it. at least in my 30 plus years in the business. So I wanted to talk about the two previous times Fed chairman used the word pain or something equivalent to that, and what happened to the stock market after they said it. Okay. So the warning number one was Greenspan, and this was on January 20th of 1999. Okay, so he was before the House Ways and Means Committee. And Greenspan told the lawmakers that the rally in stocks was unusual. He said the rally in stocks, because at that time, for example, nearly 80% of the gains in the NASDAQ had already occurred over the last couple of years. In other words, the market at this time was going up. And he said that the rally in stocks was unusual as it wasn't being driven by rising earnings, kind of like what's going on right now, folks, and took the warning to another level when he said the rally, quote, will likely have difficulty in being sustained, unquote. So what happened to the markets after the warning? Well, they initially rallied at first, but then Greenspan's warning proved to be accurate, as we all know. And in early 2000, stocks rolled over hard, and especially the tech bubble bursts, and the NASDAQ ended up falling 85%. And by the way, the S&P 500 had fallen 38% from the level it was at when Greenspan made his warning on January 20th of 1999. In other words, the S&P fell another almost 40%, for a total drop of 49.1% on the S&P 500. The NASDAQ fell 85%. Warning number two was Bernanke. Remember old Ben Bernanke? He acknowledged the risk in subprime mortgages, but called the risks contained. Ooh, there's that word risk. But so Bernanke, also testifying before Congress, acknowledged there could be some pain. He used the word pain in the housing market. What happened to the markets after the warning? Well, 1 year from his cautionary, let me say that again, folks. After his cautious commentary on housing, the S&P 500 didn't bottom until March of 09. In other words, this was, basically where the crash of 08 finally bottomed out in March of 09, dropping more than 40% more from the day that Bernanke used the word pain. Okay, so what does it mean for the markets now? Well, Powell warned of some economic pain ahead, so we should all prepare for that pain. Okay, so, and second, be suspect, folks, of any relief rallies following these warnings, because in both previous warnings, stocks rallied for months before the economic realities both Fed chairs warned against came to fruition. So I just wanted to make that little point to you. Now, are we in a recession? Now, I've had people say, these are people sometimes come in and talk to me. They say, hey, Mike, I'm retired. Why do I care if there's a recession? Well, the reason you should care is summed up in this quote from Peter Lynch. Now, folks, in case you don't know who Peter Lynch was, I know some of you know, but years ago, he managed a mutual fund called Fidelity Magellan. While he managed it, it was the #1 performing large cap stock mutual fund in the United States for years. Everybody called him the wizard. And in fact, what finally made him quit was Fidelity promoted him, which may have been the dumbest thing they ever did. And the guy that replaced him could never get the returns back where Lynch had them. So this is a quote from Peter Lynch, who, by the way, he still works for Fidelity, as far as I know. He said, you get recessions, you get stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. So now, So that's why, and folks, and again, I don't get political, again, I'm very apolitical. I have clients that are Democrats, clients that are Republicans. I'm just interested in protecting my clients' money and helping them get decent returns. But I want to point this out. Right now, we've got the Fed chairman who won't acknowledge this is a recession. He was appointed by a Republican. And we got our president, who's a Democrat, saying this is not a recession. So the question is it a recession or not? Well, let's just look at some things that are big red flags. First of all, folks, the Consumer Sentiment Index is published every year by the University of Michigan. This index, the Consumer Sentiment Index, is used by many, many analysts as a way to tell if the consumer is being very negative on the economy or not, because the consumer makes up about 75% of gross domestic product. So if the consumer starts getting negative, historically, you go into recessions. Now you see this red arrow over here on the right, folks, which is at 50. That is where we are roughly at today. Now, we were at 50 in June. I think right now we're at 53. In other words, we're hovering around 50. That is the lowest level the Consumer Sentiment Index has been at since 1952. It's the lowest level in 70 years. In any time it ever got anywhere near this level, and it never got to this level, we always went into a recession. You see those vertical gray bars up there? Those bars are recessions, folks. So with the Consumer Sentiment Index this low, whether they declared a recession yet or not, because the one that has to declare it is the NBER, that's the National Bureau of Economic Research. This is a very strong indication that we are already in a recession. Okay, now I want to show you something else. As there is a very strong red flag that has pretty much always pointed out that you are in a recession, and that is called an inverted yield curve. Now, all this is, folks, is this is where you take the yield or the interest rate on a 10-year Treasury bond, and then you take the yield on a 2-year Treasury bond. Now, most of the time, if I put my money in a 10-year Treasury bond, I would expect to get a better interest rate than if I put it in a 2-year Treasury bond, right? Because I'm locking my money up for 10 years. So you should expect to get a higher rate of interest. But every once in a while, they invert, where all of a sudden the yield on the 2-year is higher than the yield on the 10-year. And that is always a dead giveaway that you're going into a recession, okay, when they invert like that. Now, if you look at that jagged black line, again, that's the yield curve. And every time it goes below that, you see that dash line there, folks, going across my graph. Whenever the yield curve goes below that dash line, that's when it inverted. Now look at when it inverted, and look at those vertical blue bars, which represent recessions. Folks, you'll notice every time the yield curve inverted, after that, we went into a recession, or sometimes we were in a recession. Well, notice the yield curve is now inverted. In fact, a few weeks ago, it had the widest spread that it had since the year 2000, after which the market fell about almost 50%. Okay, so again, I just showing you some things that lead us to believe that we're likely in a recession. Now, I'll show you something else here, folks. The National Association of Home Builders reported that both the Builder Confidence Survey, in other words, how confident the builders are, and the Traffic of Prospective Buyers Index continue to drop as what we call stratospheric home prices. In other words, house prices just going through the roof, and decade-high mortgage interest rates have created a housing affordability crisis. And in other words, they're keeping would-be home buyers on the sidelines. How things have changed in a year, folks. In fact, the National Association of Home Builders stated that conditions have gotten so bad in the housing industry that they claim they are now in a housing recession. And if the housing market is headed for what is called a hard landing, which means a recession, as this NAHB survey indicates, it could seriously exacerbate the depth and duration of the recession. In other words, if housing starts getting real bad, folks, it'll just make the recession deeper and last longer. Okay, and and again, the National Association of Home Builders they're declaring they are already in a housing recession. Now, I want to show you something else. I actually showed this chart. A few weeks ago, I sent it out with a letter. But here's the way to think about this, folks. If you look at that black line that's bouncing up and down across the graph, that's inflation, okay? The blue line that's kind of starts at the bottom on the left and climbs up to the right, that's the stock market, is measured by the S&P 500. And those gray bars are recessions. Okay, now watch this, folks. Now just follow my arrow. Now, if you watch inflation, see my arrow over there on the left, so follow my arrow, there's inflation climbing. It got up to about 6%. This was in 1970. Notice the gray bar, we went into a recession when inflation got up to 6%. Now drop down and look at the stock market, boom, it fell. That was a really nasty one too, it fell almost 50%. Now look at this, folks, inflation climbed, whoa, almost to 12%. Notice the gray bar behind it. We went into a recession. Now drop down to the bottom, look at that. Remember that 74 crash? The market fell almost 50%. Now look at this one, folks. Holy cow. This one, the market got up to almost 15%. I'm sorry. I'm saying the market, I mean inflation, excuse me. I hope I said that for this one too. That was inflation. So the inflation rate got up to almost 15%. Notice we went into a double recession. You see the two gray bars, and then boom, the market fell. Now, I want to skip all the way over for sake of time to the 08 crash, folks. Look at this where my arrow is. Now, inflation is now down here. You can see inflation got up to about 6%, went into the Great Recession, and boom, we had the second worst stock market crash in U.S. history with the S&P falling 57%. Now watch this, folks. See this black line, which again is the inflation line. See where it is now? It's at about 8.5%. Notice it's at the highest level. Let's just put my arrow there and start backing up. Notice it's at the highest level it's been since the early 80s, okay? So what the point is, normally when you get inflation of around 6% or higher, we've had recessions just every time, folks, and subsequent market drops. Okay, so, and I'm telling you, the market has dropped some, and we've had what we believe is a false rally, but we don't think it's done yet. But I'm just trying to, right now, what I'm trying to do here, folks, is lay a background for you on why we believe that we are already in a recession, okay? So now, I want to show you, bear with me again as I change my slide here. Could inflation be peaking? People are asking, well, was it 9.1 and then it dropped to 8.5%, so does that mean inflation is peaking, because it dropped to 8.5 in August? Well, folks, we'll talk about that, but first I want you to see this. This is where inflation on individual items is right now. Now, if you look, you see where my arrow is right here. It says overall CPI, that's Consumer Price Index, which means inflation is at 8.5. So how many items are, where the price is rising faster than 8.5 and how many prices is it rising slower than 8.5. So you can see medical care the last 12 months was up 5.1. Clothing was up 5.1, shelter up 5.7, used cars up 6.6. Food, pardon, that should say food, not ood, away from home is 7.6. Now look at this, transportation is up 9.2, so it's ahead of average inflation. New cars year over year, in other words, the last 12 months, the prices increased 10.4. Food at home has increased 13.1. My wife says that's absolute baloney. She said food inflation is a lot higher than 13. Actually, I do trust my wife. She's probably right. Electricity is increased 15.2% from a year ago. Gas utilities, folks, as we all know, is up over 30%. Gasoline, even after coming down, is up 44%, and fuel oil is up 75%. And I want to say this, folks, there is still upward pressure on the price of many items, and it is also being aggravated by the war in Russia. I'll give you an example. Russia is the #1 exporter of fertilizer in the world, and guess what? Because of this war with Ukraine, we're not buying fertilizer from them. And if you talk to any farmer, they'll tell you that the cost of their fertilizer has like tripled. And they're saying that hasn't even hit our pocketbooks yet. And they're claiming this later this fall, the food prices, because of the dramatic increase in fertilizer, is going to even go higher. In fact, some farmers didn't even, farm this year. And I want to also say this, folks, people are not aware of this, but Russia is the #1 exporter of natural gas in the world, and they are or were the #1 supplier of natural gas to Europe. And I use the word were the #1 supplier of natural gas because many of you know just in the last few days, Russia cut off gas supplies to Europe. Have any of you ever heard of the Nord Stream 1? That is actually a gas pipeline that is owned by basically the state, in other words, by Russia. So it has now completely halted gas supplies in Europe through that pipeline. And Vladimir Putin, we all know who he is, the nutcase that's caused this war, said that Western sanctions have played a part in gas pipeline interruptions. In other words, he's saying, well, because you're putting sanctions on me, I can't get the proper parts. So, my pipeline isn't working anymore. And of course, that has been already confirmed that that's nonsense by some of the suppliers of his parts. But Europe has historically been reliant on Russia gas to meet its energy needs. And folks, this just happened in the last few days where Russia basically said they're not, at least for right now, supplying natural gas. And my point of this is, this could cause huge slowdowns in European economies and accelerate the severity of their recession, which, again, I'm not here to talk about Europe's recession, but it does look like they are also, going into a recession just like we are, okay? So now here's something else, folks, I want to show you. Let's say inflation is peaking. Now, I don't know if it is or not. I mean, it is going to peak sometime. Does that signal that we're at the bottom, at the stock market bottom? In other words, where the market's going to be at the bottom and just start going up? Well, let me show you a little history, folks. During the dot-com bear market, that started actually in March of 2000. Okay, inflation actually peaked in June of 2000, but the eventual bear market bottom didn't happen until October 9th of 2002. Over 2 years later, we're in the market after inflation peaked, fell another 46.15% from the inflation peak. Okay, so just because inflation peaks doesn't mean this is over. During the great financial crisis, in other words, the 08 crash, inflation peaked in July of 08, okay? With the eventual market bottom on March 9th of '09, about 7.5 months later. And from the inflation peak, stocks based on the S&P 500 fell another 46.62% from the inflation peak. So inflation peaks, contrary to what some of these talking heads have been suggesting, does not at all suggest we're near a stock market bottom. Okay, now I want to show you another reason why we believe you can almost put it in the bank that we're in a recession, folks. You know, if we go back and look at the last 10 recessions before this one, if this is a recession, every one of them where you had 2 consecutive quarters or more of negative GDP, the last 10 in a row where you had 2 negative quarters or more of negative GDP, it was always later declared, to be a real recession. Okay, just so you know that. And see, the recession is not official until it's declared by the National Bureau of Economic Research, who always does it. They normally won't declare it till the recession is almost over. And by that time, it's too late to protect yourself. Okay, so I just wanted to point that out to you. And folks, I have one more thing I want to say about why we believe we're in a recession. And that is low unemployment, okay? Because again, some of the talking heads recently have been declaring that there is no recession because unemployment is so low. In other words, the unemployment rate is at 3.7, and they say you couldn't possibly have a recession with unemployment at 3.7. Well, folks, let me point something out to you. Unemployment does not rise before a recession. But instead, it rises after the recession starts. And this is something a lot of people don't understand, but it's also what's causing confusion is some of these talking heads, again, on these financial programs, suggesting that, you know, because of low unemployment, we're good, there's no recession. Well, listen to this, folks. For example, let's consider the last 3 recessions, and let's compare unemployment at the start of the recession. In other words, was it low at the start of the recession like it's low right now? And also, let's look at the average recession for the year leading up to the recession. In other words, by doing this, we can tell if unemployment rose, like in the few months before the recession started, did unemployment rise? Because if it did, then the argument that we can't go into a recession with unemployment this low would have some merit, okay? But it doesn't, folks. But listen to this. In the dot-com recession, it officially started March of 2001. Okay, now the average unemployment for the year leading up to that recession was 4%. Okay, the last unemployment reading before the recession started was 4.2%. So in other words, the unemployment rate basically hadn't changed. But by the end of the recession in November of '01, unemployment had climbed to 5.5%. Okay, so in other words, at the beginning of the recession, unemployment was low. In the 2008 recession, the recession officially started in December of '07. The average unemployment for the year leading up to the recession was 4.6. In other words, for roughly the previous 12 months, the average unemployment was 4.6. The last unemployment reading in November of '07, right before the recession started, basically was the same. It was 4.7. Okay, but by the end of the recession in June of '09, unemployment had climbed dramatically to 9.5%. And then finally, in the COVID recession, which officially started in February of 2020, the average unemployment for the months leading up to the recession was 3.6. The last reading before the recession started was 3.5. Once again, verifying that you had low unemployment at the beginning of the recession, but by the end of the recession, this is the pandemic recession, in April of 2020, unemployment had climbed to 14.7. Folks, maybe I'm giving you more information than you want to know, but the moral of the story is unemployment, low unemployment right before a recession does not mean you're not in a recession. Or another way, unemployment does not rise before a recession, but instead it rises during a recession. So this idea that low unemployment means there's no recession is bogus, to put it, if I may just be that blunt. Okay, now the next thing I want to do, and by the way, folks, something I might also mention, people have said, well, gosh, they added 528,000 jobs in July. That means the economy is healthy, and they added 315,000 jobs in August. But again, jobs are what you call a lagging indicator historically. They do not really predict anything as far as going into a recession. A much better indicator for recessions are what you call initial jobless claims. And the recent 4-week average of initial jobless claims, which again is a much better indicator of whether or not you're in a recession, has climbed 84,000 from what they call the cycle lows. And the bottom line, that has historically meant we're already in a recession or we're about to enter a recession. All right, so enough on unemployment. So now, folks, I want to talk about recessionary bear markets, because there have been a number of bear markets, and a bear market is where the stock market falls 20% or more. But there have been some bear markets where you didn't have a recession. Okay, but when you have a bear market accompanied by a recession, is there a difference? And the answer is yes. Bear markets accompanying recessions are much deeper and last much longer. And the last 3 recessionary bear markets averaged a 46.7% decline in the S&P 500. Okay, just so you know. And the S&P 500 has not fallen anywhere near that much yet. Okay, now I want to show you something else here, folks. Do you know, if you look past what I call the aberrational bear markets that were just caused by some weird aberration, like, for example, the 2020 bear market was caused by a virus. Okay, so that was kind of a weird aberration. In 1990, you had Iraq invade Kuwait, and you can see that on this little chart. That was a real short bear market. Here's the 2020. That was a real short bear market. The 1987 flash crash, where the market, remember that, where it dropped almost 40% in one day and then totally recovered by the end of the year. If you throw those aberration bear markets out, then today's bear market, if it's over, would be the shortest bear market in the last half century. And with the Fed's inflation battle still ahead, it would seem very foolish to jump on any bullish bandwagon while all these warning flags are flying so high, like some of the warning flags that I've been showing you, folks. Okay, so now I want to show you something about the path of a bear market. Okay, because recently, and let me go to my next slide. I'm so excited about showing you these slides. But now, folks, we're going to take a quick history through some of the worst bear markets in the history of the United States. Plus, we're going to look at 2022. Okay, so we recently, up until about September 16th, we had, I'm sorry, it was up at, I said that incorrectly, but we recently, up until a few weeks ago, we had what I call a rally of 17%. You can see it right here. This is in this 2022 bear market. So in other words, we had a 17% rally of the past 2 months, and it triggered widespread expectations and hopes that the 2022 bear market was over. And I want to tell you, we are very skeptical, not only because of the alarming warning flags I've been showing you, but because we know stock market history. And I want to share an insightful lesson about, again, past major bear markets that turned out to be much larger and longer than originally expected. And the historical truth is that protracted bear markets have numerous rallies. So we've had, you can see it in this first chart for 2022, we've had 4 false rallies. I call them false. Now, maybe, if you think we're at the bottom, then you can disagree with me. But I believe we've had 4 false rallies. In other words, false means they went up, but they're going down, and the bottom is nowhere near in sight, ranging from one that went up 6%. The best one was this recent one where it went up 17%. Now let's look at the 08 crash, folks. You see the second box here. Now, folks, this is an interesting one because this is the second worst stock market crash in U.S. history. Now, if you count all the little rallies, and by little rallies, I'm talking about where it just went up 5%. If you count rallies from 5% or more, there were 12 bear market rallies ranging from 5% to the biggest one was 24%. You can see it way down here after the market pretty much got clobbered. Okay, and yet even though it had 12 rallies, or we call them bear market rallies. A bear market rally means it's a false rally, folks. It goes up. They sometimes call them sucker rallies. It's where the market goes up, right? It goes, hooray, it's over, and then boom, it goes down. It's torture to go through this. So after those 12 bear market rallies, you can see all the way down at the bottom where the market finally hit the bottom on March 9th of 09, falling 57%, which means if you had $1 million at the top, by the time it got to the bottom, your $1 million was worth $430,000. Now, this next one is the .com crash, they call it. But again, I'm not looking at the tech index. I'm looking at the S&P 500. And you can see there were 8 false rallies. Just look at the 8 green numbers, folks. We call those false rallies ranging from 5% to 21%. And yet the S&P 500 ended up almost getting cut in half. It fell 49%. And by the way, I'm not showing you the NASDAQ, which is considered the tech index in some people's minds. It fell 85%, folks, the NASDAQ during that drop. Okay, so now we're going to go back further. Here's the 73.74 class, or 73.74 drop. Some of you were not born yet. Some of you may have been in college. Some of you may have been in high school. I don't know. Some of you might have been kind of old during this. I don't know. But in the 73.74 class crash, there were 9 bear market rallies ranging from 5% to 11%. Yet you can see down on the bottom, the market ended up falling 48%. Now we're really going back, folks. The 1938 drop, there were 7 false rallies. The best one, the market actually recovered 29%. You can see it right there. I'm sure a lot of people thought, hooray, it's over. And then boom, the market had a really nasty drop. But by the time it got to the bottom, you can see it fell 46%, once again, almost cut in half. Now I'm going to show you 2 more, folks. This is really going back there. Was anybody alive in 1937 that's on this Zoom call? If you were, I'd like to know. I can think of a couple of the clients that were alive. They were pretty small, but in the 1937 crash, folks, there were 10 bear market rallies. The best one recovered 16%. You can see it kind of down here on the bottom. By that time, it hadn't done much good. And yet, look at this, the market ended up falling 55%. Now, the last one I'm going to show you is the mother of all stock market crashes. This is the worst crash in stock market history. Many advisors don't want to show you charts like this because they don't want you to think, oh, could it ever be this bad? And I don't think it could be this bad. Actually, I don't want to get in all the reasons why, but I'd like to think with a lot of the, the computer programs they have now, they catch it before it ever got this bad, folks, but who knows? But you can see that there were 18 false rallies in this crash. 18, folks. The best one recovered 31%, way down here near the bottom. By that time, again, it didn't do much good, but yet the market ended up falling. Look at this, folks. This is not the NASDAQ. This is the S&P 500. It ended up falling 86%. For the S&P to go down that bad, that was bad. That's why people, they said they were jumping out of windows, because they lost their fortunes in that one. And it took years. I think it took like 20 years just to get back to zero in that one. So that was terrible, folks. Now, why am I showing this to you? My objective is simply to reveal why we're not overly concerned about this latest stock market rally that just ended, it lasted a couple of months, because you know what, folks, the way we manage money, it's safety first investing. In other words, it means choosing your own investment odds. And based on the summary of evidence and the increasing recession warning flags, we don't like the current odds, okay? Just so you know that. And never mind the fact that all three of our buy-sell signals are warning us that we should stay out of this market, okay? Because, folks, the market is just like, like one of our past Fed chairmen said, Greenspan, when he talked about how the market going up is not being justified by the earnings. That was his polite way of saying, hey, guess what, folks? This is, what's that word? Investor exuberance, just because you have a lot of unsophisticated buyers buying stocks, which temporarily can drive the price up, doesn't mean it's the rational thing to do. The number one thing to watch to protect yourself are earnings, and the earnings are starting to decline, folks, as they always do when you hike interest rates. Now, something else I want to show you here, that kind of ties in to declining earnings, which leads to bear markets. Okay, now, folks, remember, a major factor that causes earnings to decline is when the Fed starts hiking interest rates, because it slows down the economy and makes things more expensive for consumers and businesses, when they try to buy things on credit. So here's something, this chart is a little spooky to look at, okay? So see, if you look at this middle column right here, this is the consumer price index, okay? And actually this top number up here, which is 8.5%, is where the consumer price index is right now. Okay, but now look down below this line, folks. You see, do you notice this is down here, this is inflation going from November 30th of 1973 through January 31st of 1982. In other words, we're looking back at the 70s and 80s, and do you notice inflation was roughly at the same level it is today? You see that right here? Almost the same as it is today. But you know what's different? Look to the left, folks. At the Fed funds rate in the 70s and 80s, it averaged between about 9.5% and 14%. That's how high they had to hike them to stop the inflation from going out of control. You know where the Fed funds rate is right now? There it is. Look, folks, at the top, this is as of July 31st. It's still there. The Fed funds rate is at 2.3. Now think about this, folks. The Fed has a long way to go. In other words, I think they just don't want the public to know yet what they're in for, because they're not trying to cause, spook the public, okay? But I am telling you, to get this inflation under control in the 70s or 80s, they had to get the Fed funds rate up to 9 and eventually up to 14% to stop it. And right now we're at 2.3% with the same Fed funds rate. So what do you think? I mean, do you think? And folks, remember, the worse they hike rates, the worse the recession is going to be. And ultimately, in our opinion, it's very likely the worse the stock market drop is going to be, all aggravated by this crazy thing going on in the Russia-Ukraine war. Okay, but now, I've had still, in spite of what I'm showing you folks, I have still had people say to me, well, Mike, what if the Fed does the Fed pivot? Remember a few weeks ago, people were talking about the Fed pivot. And what the Fed pivot was, everybody was expecting Bernanke, a couple of Fridays ago when he made his very hawkish announcement about pain. Remember, he used the word pain. Folks, it's funny, when I'm looking at this camera and I don't see you, it's easy to get animated, but it's hard for me to visualize my head. I got a couple of hundred people watching me, so forgive me if I get a little excited here. But when Bernanke was talking about pain, okay, but before that meeting, many analysts and the talking heads were saying, well, Powell's going to do a pivot. In other words, the pivot means he's going to pivot and say, guess what? We're going to slow down the rates. We're going to kind of not be so hawkish. We're going to get more dovish, to kind of help get a soft landing and not have the stock market have a big drop. Okay, but that's not what he did. He didn't do the pivot. And we kept telling people that was a false rally, that where the market went up. If you read my letters the whole time, I was telling you that this was not sustainable. And, the other thing was that Jerome Powell didn't do a pivot, did he? In Fed, he got very strong in his language. And again, as I shared with you early, used some terminology that is very rarely used by a Fed chairman to give us a clue, folks. And so, but having said that, let's say the Fed does stop raising rates. Now, how many of you think they are, right? But let's just say they do, because I've had some people say, well, maybe they will. Okay, well, let's just say they do. Are we safe if the Fed stops raising interest rates, which again, folks, is not very likely? Well, in February of 1989, the Fed stopped raising rates. And guess what? The market didn't bottom till October of 1990, 20 months after they stopped raising rates. In May of 2000, the Fed stopped raising rates, and the market didn't bottom until October of 2002, over 2 years later after they stopped raising rates. And in June of 2006, the Fed stopped raising rates, and the market eventually hit its lowest bottom in March of 2009, almost 3 years later. I'm just trying to put to death this crazy idea that just because the Fed stops raising interest rates, that somehow that means we're at a market bottom, okay? That's historically not how it works. But on top of that, folks, the Fed's not done raising rates, trust me. They're about to raise them again, and I think it's going to be 75 basis points again, but we'll see. It's coming up here pretty soon. Now, I want to show you something else. This chart shows that the most volatile years where stocks are having a lot of these 1% to 2% swings occur in bear markets. And some of the bigger bear markets have seen these 1% to 2% swings on nearly half the trading days in the calendar year. So if we look at 2002, if we extrapolate the number of 1% to 2% swings in the S&P 500 so far in 2022, we are in what I call rarefied air, folks. Now let me show you what you're looking at. You see those blue bars? Those are showing the number of days in that a given year where the stock market swung, 1% or more. And then the red bars show where it swung, 2% or more. So, and you see those blue arrows up there, folks? Those blue arrows show stock market crashes. So you notice when the bar climbs the highest is when you seem to have the market crashes. Okay, now look at this arrow here where my arrow is, folks. That was the 2008 crash. You see how You had a lot of the days where you had these 1 and 2% swings, and that was definitely led to a bear market. Now you see way over here on the right where the asterisk is, that's today, folks. The second highest level of volatility since 1960, and we're not done with the year yet. Okay, so what I'm saying is, if we extrapolate the number of 1 and 2% moves in the S&P 500 so far this year, for the full year, again, we are in rarefied air. In fact, if this pace of volatility continues, folks, it'll be comparable to the most severe bear markets of the past 60 years. I'm talking about 1973, 74, the 2000 dot-com crash, and the 08 crash. At this point, folks, I'm telling you, it would be dangerous to assume that we're at a market bottom, or that this is somehow some kind of a mild bear market. Okay, now I'm going to show you. I have one more slide, folks, on bear markets that I think is very powerful that I want to show you. And that is this. In other words, I want to basically just point out something that is rarely talked about that points to further drops in the market. Now, first of all, folks, you notice up there it uses the term at the top, margin debt. Well, margin debt measures the amount of money borrowed by investors to purchase stock, where people buy stocks on margin. And it can be a useful gauge to show you where the market top is. And if you notice over the last almost 60 years, when margin debt peaked, you see those red arrows up there? That's showing you where margin debt peaked. In other words, where people have the most money borrowed, for buying stock on credit, that the stock market also peaked. And that makes some sense, because if you're, borrowing stocks on credit, you're buying extra stock, right? So that's going to tend to push the market up. But so look at those red arrows, folks. Now drop straight down, follow those red dashed lines straight down, and look at that. Where the margin debt peaked, the stock market peaked. You see that? So margin debt began to slip last year as what I call the animal spirits. All these, aggressive investors started to fade, and, has since collapsed. Margin debt has collapsed dramatically. In other words, people have stopped, started cashing out, not having so much stock on credit. And look at this last red arrow, folks. You see how there's the peak up there last year, and you see how bad that's dropped. What that's showing you is that margin debt basically has collapsed, okay? And significant drops in margin debt have always been associated with major bear markets. Like look at the 2008, where margin debt peaked. You see the stock market peaked, margin debt collapsed, and the stock market took a huge drop. Look at the 2000 crash, folks. Margin debt peaked up here, it started collapsing, and boom, the market started falling. But guess what, folks? Now, today's plunge in margin debt, which you can see, again, follow my arrow, folks. See up here, this big plunge in margin debt has not seen a proportional drop in the S&P 500. In other words, go down, follow the little red dash down. There's the S&P. Now it's dropped a little bit, but it hasn't dropped proportionally to how bad the margin debt has dropped, but it always has in the past. Okay, so I'm just pointing out, this is a huge red flag, folks, that we have a ways to go. Moreover, I want to point something else out. Margin debt often rises rapidly in the initial stage of a stock market recovery. And there are no signs so far of what I call the smart money re-engaging in leveraging. In other words, buying stock on credit. Okay, we aren't seeing that yet. This chart, folks, in our judgment, is a huge red flag that we are possibly in a more severe bear market with a ways to go. Okay, again, I want to remind you, recession, if you take the average of the last 3 recessionary bear markets, they fell 47%. We haven't fallen anywhere near that much. And if I throw out the COVID one and just take the 2000 to 2008 one, the average between those two is about a 53% drop. Okay, now I've got to hurry along here, folks. People took bets on is Mike going to finish in an hour? Well, sorry, I'm a little past that, but I'm getting close. Now, folks, I want to talk a minute about bonds. People say, what in the world happened with bonds? Well, folks, just so you know, we had the worst drop in bonds for the first 6 months of 2022 in history based on the 10-year Treasury bond. Now, and if you look now, if you notice my chart on the top, it says U.S. 10-year Treasury bond, total returns from 1928, that's how far back this goes, to 2022. And so you can see the return, in green, it was positive. When it was pink, it was negative. And now, the thing that I want to point out to you folks, all the years that you're looking at up there, except for 2022, are showing a full year. Do you see what I mean? They're showing a 12-month period. If you look at the 2022 return, that was for the first 6 months of this year. So it was only a half a year. Okay. But what I'm pointing out though, is if it stays on the same trajectory as it did the first 6 months, it will end up being the worst bond market drop for a 12-month period in history. Now, for a 6-month period, it already has taken the record. It's the worst drop for a 6-month period. You can't tell that by looking at this chart. Why? Why did the bonds get clobbered so hard? Folks, you know what? I have been amazed how many people have been in my office. These are not our clients. These are just people coming in to see us and their accounts are down, much more than ours. In other words, some of them are down like 18, 20, 22%. And what they didn't realize is a lot of the damage was caused by not getting out of their bonds. We got out of the bonds in January, folks. I don't know if you know that. Hooray, our bond signal went negative and we got out in January. But a lot of people didn't realize that one of the reasons there was so much damage on their portfolio wasn't just because of the stocks. It's because the bonds went down. People come into my office and they say, Mike, I thought when stocks went down, bonds went up. And that happens sometimes, folks, but it sure didn't happen this year. And it sure didn't happen in the COVID crash in 2020. And it sure didn't happen in the 08 crash. But this is on track to be the worst bond drop ever, folks. And, the thing I will tell you, there is a very popular bond fund, and it's called the iShare, it's put out by that BlackRock, the iShare, what is it called? The iShare iBox Corporate Bond Fund. The symbol is LQD. We've used it before. I think we used it last year for part of the year. That bond fund is down right now about 18%. It's folks, I mean, to a bond to be down 18%, are you kidding? Now, of course, we're not in bonds. We haven't been in bonds all year, so good news for you. But now that's because of interest rates going up. Folks, some of you may know this. Now, I'm sticking my arms out like this because to show you something. This is a teeter-totter, okay? So when interest rates go up, the bond price goes down, just like in other periods. When the interest rates went down, the bond price went up. Okay, but right now, when interest rates go up, bond prices go down. People say, well, why? Well, here's the reason why, folks. If I have a $10,000 bond paying, let's say 4%, what is 4% of $10,000? It's $400. But now the interest rates go up. So the new bond, the same bond, brand new, instead of paying 4%, is now paying 6% because just like a CD at the bank, if the rates go up, would you go in to buy a new CD that you'll get a better interest rate? Okay, so now I go in to buy that same bond, but they're paying 6%. What's 6% of $10,000? It's $600. So nobody is going to buy your bond that's, because you only got 4% on your bond because you bought it a year ago. So your bond is only generating $400. My bond, the same bond, but it's newer, is generating $600. Well, nobody's going to give you $10,000 for your bond when it's only paying $400 when the new ones are paying $600. They'd be dumb to do that. So guess what the bond markets do? They lower the price of your bond until the price of your bond makes the $400 equal 6% in my example. Now, some of you are going, what the heck did that guy just say? Well, okay, that was my attempt to explain it. But if you don't understand that, folks, the thing you got to understand, when interest rates go up, bond prices go down, and they are hiking interest rates more aggressively than they have in over 40 years. And I'm telling you, they got a ways to go, and bonds are not done getting clobbered. Now, having said that, I'll also tell you something else. The one redeeming quality of a bond that a stock doesn't have is that a bond has a maturity date, just kind of like a CD at a bank. So no matter how bad the bond goes down, if you hold it till maturity, you'll get the original amount of money back. And that kind of acts as an anchor to the price of the bond where it'll only go down so far. Okay, so that's good news. And the other thing is, and partly for that reason, we're predicting the bond market is probably going to bottom out possibly sooner than the stock market. And so we do, just like this happened in some other periods where bonds got hit, we do see a buying opportunity coming with bonds, because remember, folks, we're out of the bond market. So if these bonds keep going down, we're not going down with them. We're maintaining the value. And then when they get near their lowest level, that's where we see a very strong possible buying opportunity that is coming. You say, well, when's it coming, Mike? I wish I could tell you exactly, but we think it could be sooner than the stock side. I'll just say that. Now, a couple of other things, folks, I want to say, and then I'm going to be done. In some of our models, and it's basically the symmetry plus growth models, like some of you are in a 60-40, some of you are in a 70-30. We do sometimes short the market. And I want to explain what that means. And by the way, if you ever didn't like that, all you got to do is call us and we can move you into another model that doesn't do it. But historically, it has made extra money for the clients. But here's how this works, folks. And just to back up and give you a little reminder, when all three of our signals, our stock signals, turn green, remember how we drop the bonds and go all stock because the upside potential is really strong and the downside risk is really low. And if you're in the leverage version, when all three signals turn green, we drop the bonds, go all stock, and we put a small part of the portfolio, basically 20% of the portfolio, in a double leverage ETF, so it'll go up twice as fast. In other words, if I put my money in a double leverage ETF cloning the S&P 500, if the S&P 500 goes up 10%, I'll go up 20%. But if it goes down 10% and we don't get you out, you're not going to go down 10%, you're going to go down double, which, by the way, has never happened because it's done under such strict circumstances. But the other part that is much more rare with the leverage version is that also when all three of the main signals turn red, we short the market. Okay, now there are some qualifying things that have to happen. Sometimes with our overrides have to line up a certain way for this to occur. But without getting on all the rabbit trails, here's the big thing to understand. When all three of our main signals turn red, in other words, all three of them are saying, get out of the market, which is what's going on right now. Then if you're in the leverage model, 80% of your money will be out of the market, which it is. In other words, it's right now we're in cash equivalents, which are T-bills and government money market funds. But the other 20%, we put in a double leverage inverse ETF. The key word is inverse. So here's what that means, folks. If I'm in a double leverage inverse ETF, that's cloning the S&P 500, and that's the one we use. That means if the S&P 500 drops 10%, I'll go the opposite direction, double. So I'll go up 20%. But if all of a sudden the S&P 500 goes up 10% and we don't get you out, okay, you're not going to go down 10%. You're going to go down double. So you'd go down 20%. Now I'm going to say that again, folks. Again, on a double leverage inverse ETF, if the S&P 500 drops 10%, you'll go up double. So you'll go up 20%. But if all of a sudden the S&P 500 turns around and goes up, for example, 10%, you'll go down double. So you'll go down 20%. Again, it's never happened where it went down that much, folks, because again, it's done under such strict circumstances. Now, having said that, I want to also point this out. When we are shorting the market, the S&P 500 is not going to go down every single day. How many already knew that? It's kind of like, duh, But I mean, sometimes people, I'm not trying to be mean, folks, but most of our clients understand this, but sometimes we'll have somebody that just, is not connecting the dots. Like, hey, why didn't it make money today? Well, that's because the stocks went up. And when the stocks go up, when you're using a double leverage inverse ETF, it'll go down. Sometimes it'll go down a few days in a row. And the answer is we're not the most confusing thing you can do with our shorting strategy is micro look at it. In other words, where you're looking every single day, because the thing we can tell you, folks, over any meaningful period of time, it's always made money. And in other words, there may be a few days it won't, there may even be a cycle it won't, but overall it's made money. Like, for example, this year, there were 3 times up until this week where we shorted the market for a few days, okay, because all 3 signals turned red. And we didn't make money every single day in those 3 periods, okay? But at the end of the first 2, we netted out making money. And sometimes it's not big money. We're just doing this as something where we can make a little extra money while we're waiting for the market to have the big fall. And the way we make the big money is by, staying to the side. And when we get near the bottom, going back in and buying the stocks cheaper. Okay. But this is just something that's isn't real big usually, but a way to make a little money. So the first 2 cycles, it netted out making money. In the third cycle, it ran into that bear market rally, where the market ran up, 17%. Now, normally when that happens, the signals won't all stay red very long. One of them will turn green, which is what happened, and the shorting stops. Okay, but nonetheless, we netted out not making money in that third cycle. Okay, and again, folks, the reason I'm telling you this, nothing works 100%. And the good news is it doesn't have to be effective. Now, interestingly enough, we started shorting again. It'd been a few weeks since we did on Tuesday of this week. So we're shorting right now. And if you want to drive yourself crazy, start looking at it every day, because you'll see the symbol's SDS and it's in your account. I mean, if you have that particular model, not everybody's in that model. But the best way to do, folks, I always advise people, don't look at it every day. Let it go through the cycle. And what we find is usually about 3 out of 4 times it'll make money. And in a cycle where, once in a while, again, if we run into a relief rally, then, you can end up having it's usually a very minor, loss for that period. But the overall net effect over like if you're looking at it right there in this chart, you see those horizontal gray bars, folks, those are showing you all the way back to January 1st of 2001, when we shorted. And it's very rare, by the way, for things to be bad enough to short. You can see years have gone by without shorting once. And by the way, to give you a little history of this, if you look at all the trading days, all the way back to January 1st of 2001, there were 5,408 trading days, and we only shorted in 224 of those 5,408 trading days. So in other words, it's very rare when we short the market. And listen to this, folks. All of those shorting days, those 224 short days we shorted, occurred in the dot-com crash. You can see that where my arrow is over here. And also, some of that was still going on in '02. It was also in the '08 crash, and you can see where the shorting was going on here. 4 days in 2016, and now in this year's bear market. Okay. And my point is this: historically in our models, shorting has mainly come out of its cave, so to speak, in severe bear markets. And that is another reason that tells me this is probably going to be a more severe bear market, because of our, when our system starts shorting the market, that's a sign it's going to be a more severe market. But again, in not every instance is it going to be successful. Okay. And when it's not, you'll see a slight drop. Okay. And if you just let the whole process work, you'll see folks, it's very rare where it won't end up making money over a period of time. All right. So now, in ending, folks, now bear with me here. I have to have one more drink of this water. Okay. For those of you that have all your money in our model, in our Advance and Protect model, guess what? You couldn't be in a better place. And folks, I want to point something out. In the '08 crash, and everybody always likes to use that as kind of the model to examine a bad bear market. At the beginning of '08, our models were down about 12 to 13%. Kind of like what they are now. Now, if you have those 7 stocks, you might be down a couple of percent more, which won't matter at all, I'm telling you. But, in the '08 crash, at the beginning of the year, most of the models were down about 12 or 13%, very similar to now. Okay. But yet by the end of the year, it had been completely recovered and all of our models made money. And I showed you that at the beginning of this night. Okay. So I am telling you, if you have all of your money in our model, you couldn't be in a better place than you are right now. But some of you, I know, have money with Wall Street firms or other firms that are using a buy and hold strategy, and they're telling you to stay in the market. They're the ones that will never show you this stuff I showed you tonight. They'll say, oh, we're at the market bottom. We think it's good now, it's going to recover. What else are they going to say? They don't know. They don't have any solution. It makes their job real easy. Just stay in there, ride it all the way down to the bottom, as we like to say on our radio show. By the way, folks, if you've never seen our radio show, for Pete's sake, all of you should be watching that. It comes on Saturday from 3 to 4 on AM 560, and on Sunday 1 to 2 on WLS. And we talk always every week about Advance and Protect, what's going on in the stock market. A lot of this information I'm talking about today, all of you should watch my radio show. And I have 2 of the most entertaining co-hosts, Matt Nadeau and Ben Barzita, are 2 of our very smart wealth advisors. It's a great show, and I encourage you to watch that. But now, getting back to my subject, some of you I know still have money at some of these other firms that are buy and holders that are telling you to just stay in the market. And let me just tell you something, folks. We have a very good business. I'm not saying this for my benefit. I'm really saying this for you as clients because I care about you. But with the S&P 500 was down this year as much as 24%. Okay, and it right now has come back a little. And you have an opportunity to exit the market, especially if you think it's going to get worse. All right. And remember, folks, the last 3 recessionary bear markets averaged falling 47%. And if that happens this time, we have another 30% or more to go. And if we're wrong, which by the way isn't likely, our 3 signals will turn green and we'll get back in. And most of you, that are in our models are in the models where we drop the bonds and go all stock. And even if we're a little behind, when we go back in, we'll catch up real fast because we have twice as much in stock as the buy and hold model. You see what I mean? But if it gets worse, and I'm telling you, folks, that's what I'd be betting my money on. Some of this is a statistical probability game. And if you believe, as we do, that it's very likely going to get worse, why would you leave your money in a stock and bond portfolio if you had a crystal ball, which I know you don't, and I don't either. If I had one, I wouldn't use it anyway. But if I could see in the future and knew the market was going to go down another 30 or 40%, I'd be getting out. Of course, I'm in my model, so I am out. But if I was you, I'd be thinking about getting out, what you should do. Because the problem is, if you just get it out and set it in your own checking account, you won't know when to come back in. It'll be very hard for you to try to replicate from your house what I do. It'll never work, folks. I've had people try it. What you should do is get it out of those buy and hold portfolios and put it in your model here, at least for a year, until the risk goes down. And then if you want to take it back out, you can. I'm very serious. This is the way to protect your money. Get it in our model so that you have a plan and a strategy, not based on fear or emotion or guessing, folks, but on solid research with a good track record. It doesn't work 100%, but it works good enough that it's a sure lot better than what they're offering you now. Write it all the way down to the bottom. In other words, our system is very good at getting out near the top, not the perfect top, and buying back in near the bottom. Okay, so I want to leave you with that. All right, so I am done. So how long did that take me? By golly, it's 6:30 and I'm finishing. So listen, folks, I have enjoyed this from my end. I hope this helped you. Gee, it was like you had your review already tonight. But, if you do have any questions on this, you can email our office, call our office tomorrow. And of course, some of you, I do have your reviews coming up, as well as, Ben and Matt, have reviews coming up for you. And we'll be glad to go over any of this with you then. But our biggest thing, folks, in doing these client webinars, especially this one, is to encourage you right now. The number one thing you need to do is something that's hard for all good red-blooded Americans to do. And you know what that is? Be patient, okay? Because to make money, solid returns with low risk, if you do it the way we do it, sometimes it takes a little time. In other words, we're stepping to the side, we're waiting for the drop, and then our system will be really good at helping us go back in. And there's some other things, kind of backup things we're doing, like shorting the market. We think there is going to be an opportunity to coming up maybe sooner in the bonds to buy them back after they fall, and we can buy them for you cheaper. And also, if they keep hiking the rates, even the money markets are going to start paying higher interest, which they will. But again, just remember, folks, in 2001, 2002, and 2008, we made some good money before it was all over. So anyway, that's it. God bless you. And I'll look forward to talking to some of you when you come in for your reviews. Good night.